G'day all, welcome back. Money in the Tank, episode 63. Great to have you all with us again. Tankers, we're roaring and raring and ready to go. 3Rs. We can't wait to give you guys all the latest of what's been going on in the world of finance and markets. So without further ado, my name is Joel Seach, Principal Advisor, Harpel FG. To my bottom today.
It's Arnie, Finance Professional.
Hey, you are the bottom. That works. And Brad, investor journalist.
It's great to have you guys back with us today. So we're doing as we promised, trying to keep you guys up to date with all the latest and greatest of what's been happening. And there's been plenty to go through in the markets today. So we're going to touch on the latest RBA rates, which has come a bit of a surprise to many pundits out there, which is always interesting when you're seeing the predictions as to what people feel the RBA is going to do, and they do something completely different. We've got the Fed Reserve that's currently meeting. That's looking like it's a lay-down misere of another rate rise. We've got some banking going on. Crisis is still happening in the States. We've got a great 50-50 for you guys at the end of the pod, so hang around for that. And of course, Rivkin's rules. Anything to add to that intro there, boys, before we get stuck into Rivkin's?
Please get us at Money in the Tank on YouTube, Instagram, Facebook, and Twitter. And when you're on YouTube, hit the like, the comment, the subscribe button. And then when you subscribe, hit the real subscribe, which is the little bell, which notifies you when we post. The double subscribe. Yeah, that's the real subscribe.
Great reminder, mate. Great reminder. Thank you. So yeah, jump on there, guys. If you're not subscribed and hitting the bell, you're not a real listener. No, we love you all. We love you for tuning in. So without further ado, the Grail. Opening up to page 103 today. So it's Renee on sex and relationships. It's sex and love are definitely not the same thing.
That's the whole quote.
That's it.
Is that it?
That's it. Yeah.
Oh, Riv Dog. Okay, sex and love
Riv,
are the same thing.
straight to the point. All right, Riv Dog.
I mean, I've heard there's similar quotes floating around that I don't know, that all human behavior is driven by one of those two things, sex or love. So, even the pursuit of money. So just trying to tie it back to finance somehow. That's pretty weak.
I don't know about Riv and any sort of thing about
Riv was a full playboy.
What's the whole chapter? It's Renee on sex and relationships. So you've got a few more quotes in that chapter, boys, that we've got to get through still. So
Arnie, what I mean is I personally don't know about him, man. It's like, I know he was a playboy, but that doesn't mean I need to listen to what comes out of the man's mouth.
I think he's a very different guy with a strange past. But anyway.
Yeah, I wouldn't want to know what he's into.
He evokes good thoughts, though, even if you don't agree. That's why I like Rivkin's rules.
Let's crack into it today, guys. So RBA meeting up yesterday, Reserve Bank of Australia, first day of the month. They'd meet 11 times of the year. One of the changes that's been proposed is they meet 8 times in a year, so they have a few more breaks of the board during the calendar year. So that's one of the proposed 51 changes that they've recommended for the RBA to change. But anyway, they have met yesterday, and they raised the rates 25 basis points, and the markets were suggesting 100% on the no change, which was very, very interesting to see. I think CBA economists might have got it right, saying that they saw a 25 coming. And yeah, so really, really interesting to see that after a pause at 3.6% in April, that they've gone a 25 basis point rise to 3.85, which will then flow on to all variable loan holders and investment loans and business loans as well. So they're obviously out there feeling that employment is still quite tight, so unemployment is still low. Inflation, yes, it's coming down, but maybe not as quick as they would have liked to have seen it come down. And they're concerned that they don't want to see inflation become entrenched, and they're seeing other countries maybe around the world starting or continuing to hike, and seeing how inflation is really bitten a lot harder in other countries such as the UK and the US than it maybe has, in Australia to an extent. We have spoken about being a little bit sheltered in that, but we are feeling it. So I think they're jumping the gun and they've gone a bit hard. I think the media's come out maybe the general mainstream media, I feel always be loving to paint that doom and gloom picture. They love that sort of stuff. But I think some of the Economist articles saying if they maybe gone too hard. I'd be interested to hear your thoughts today, guys, on that. So first off, we'll start with Arnie down below.
Yeah, thanks, mate. You're spot on about the way that the mainstream media likes to paint it. But interestingly, you can sort of look at the different publications and sort of see the take they've taken. So I've had a look at, like this morning, I had a look at Sky News, and Sky News painted it as the RBA giving the bird to the Albanese government, which I thought was an interesting way to paint it. Typically a right-leaning publication, Sky News, and then you've got things like The Guardian, who was calling it a wake-up call, and I thought they did a good job in their analysis of having like an unbiased view, because they sort of spoke about what the shadow treasurer thought about the move versus what the current treasurer Chalmers thought about the move. And then you have news.com, which is also affiliated with Murdoch Media, but they had an interesting article about the RBA and the Greens, because the Greens leader Adam Bandt came out and said that the government should override the RBA decision of this 0.25 basis point hike, because we've had 11 straight rate rises since May, and that the average punter is suffering. And that's true. Like, there are a lot of people who are feeling the pain here. But
what would you say to Adam Bandt today, Arnie?
Adam Bandt, I would say that is an interesting thought, Adam, but I disagree with you, because I think that there's a reason why the RBA is a separate mechanism in our separate from our government and the ruling government of the day. And Chalmers came out and said that he would not consider doing that, and I think that's the right course of action, because I think there's interesting interplay here between the coming federal budget and the necessity to raise rates. And we've spoken at this at length, almost ad nauseum, where no one enjoys getting their variable loans hiked, because then you have to pay more. But the whole point of it is to try and remove cash from the system. And if you look at some of the numbers that came out from the RBA a week or two ago, boys, one key one which stuck out, which we discussed privately, was trimmed mean CPI. And trimmed mean CPI, for those that don't know, is the average rate of inflation after trimming away items with the largest price changes, either positive or negative. And it's a weighted average of the middle 70% of items. So some people mistakenly think that excludes things like energy, housing, and food. It doesn't exclude them. It only excludes the ones with the largest moves. So it gives you, I guess, a more appropriate picture of where CPI is at. And that did come down. It went from 6.9% to 6.6%. But as you mentioned, Jolly, probably a little bit slower than what the RBA wants to see in terms of that sort of sticky inflation. So I think we all hypothesized that when they paused, it was probably too early, and that they would see, even with their lagging data, they would see that it wasn't happening quick enough, and they'd need to raise rates again. So yeah, put us in the chair with the CBA economists and get rid of NAB, ANZ, and Westpac, because we all called it, they all didn't. My thoughts on the matter are, we'll probably see a few more before we see some pain, and then that'll prime them for cuts. And just adding on to that, before we shoot over to Brad for his opinion on it, I was having a chat anecdotally with a coworker, and I was sort of saying to him, again, if the USA keeps raising rates and we want to attract foreign investment, we have to keep some sort of pace with them. And it might be the case that we get to a point where they start cutting, but we can hold firm, which is going to be painful for us, but in the long term will be better for us as an economy. So, Brad, over to you.
Yeah, I'll be quite succinct, but personally, I think first point, Arnie, your comment about if all the other economists of the Commonwealth Bank one didn't see this coming, then and we got it right. I think it's a massive thing, because even 2 years ago when we even talked about inflation coming, everyone was like, no, it's not coming, it's transient, it's all the rest of it. It seems like it's a bit of sheeple out there. And I think they've made it perfectly clear. I don't know why, but they've made it perfectly clear that they started too late after inflation to start doing it. And that means they've admitted they're wrong, both in the US and here. And we started 4 or 5 months after the US. So they're going to be hawkish. They're going to now err on the side of the other way, especially with, like Joel said, low unemployment rates. You've got at the moment, high iron ore's prices are up 30-40%. So, half our economy basically is run off the price of iron ore, and that's up massively. Coal and gas exports are pumping national income at the moment. The low unemployment. As long as they can do it without breaking the economy, they're going to do it. And we don't really have the banking problem that America has in terms of, these community and regional banks, largely, going under. It's the second biggest bank being First Republic, which we'll talk about later. So our banking system is largely, pretty buoyant and stable compared to, I'd say, America's secondary, non-FDIC kind of banks. So it makes sense in a way where you've still got negative. It's still negative. Like, so interest rates are here, inflation's here. It's not really coming off too fast. So we're still in that territory where, even if you take one over the other, we're in negative interest rate terms from an inflation perspective. So, I mean, yes, it's hurting people. Property sales still went up. I think property prices for last month still went up nationally for the first time in a while nationally. So you've still got savings out there. You've still got money being spent. Sales figures aren't down that much. Unemployment's not that bad. They're scared of inflation because inflation, once it's entrenched and becomes just a part of the national psyche that we're used to this stuff, that's what they're scared about. So, if you're in
press release, Brad, sorry to interrupt, just to sort of make your point there, is Governor Lowe indicated that recent inflation data, yes, it showed a slight decline, but service price inflation remained really still very high and broadly based. So he referenced the experience offshore, so other countries, which pointed to the risk, but also referenced that the tight labour market and increasing wages growth are the two areas which it looked like were the primary justifications for the rates yesterday. So, yeah, service price inflation and labour market wage growth, they're still things that are very sticky, and they can take a longer time to come off.
Correct. And, I think a lot of people are forgetting also that we've got 300,000 new Australian immigrants coming to the country.
Wasn't it? It's 400,000, and then 315 the following year is forecast.
Is it 400? Okay.
Yeah.
Stand corrected, but your point adds to my point by another 33%. You've got 400,000 coming into the country. And so the amount of money that's bringing into the economy and the rest of it, again, inflation, is it hurting people? Yes. I'm not saying it's not. Was this planned well by the RBA? No. People were buying houses when the RBA was saying, 2024. But, if you're looking at all the data that's in front of them at the moment, and inflation's a scary thing about being kind of entrenched. We called it saying it's going to go up, and I still think there's going to be at least another 1 or 2 rate rises from here. I think I called at the start of the year there'll be another about 4 or 5. So I still think we're in that territory here in Australia. It'll be interesting what happens in the US, because like you said, Arnie, do we follow the US? Yes. That's a fact. And seeing what they do tomorrow will be interesting. Or tonight, our time, really. That's my little bit there, Jolly.
Yeah, and it's looking like the Fed is going to go another 25 basis points, and they're ahead of us in the rate cycle in terms of they've just got a different setup with their loans and whatnot and inflation. But so the Fed will come out and most likely go another 25, Arnie.
I think I touched on it in what I said about this issue, and I just wanted to sort of get both of your opinions on this matter, because without going into too much of a debate about whether America should have let Silicon Valley Bank fail, among others, rather than try and execute this bailout, which has led to this, I guess, maybe signs of an underlying contagion in those smaller banks. I wonder about, when you think about our environment and our Reserve Bank raising 0.25, and then the budget coming out next week, which is surely going to have some kind of way that they're going to try and ease cost of living pressures on families. And I'm wondering on what your perspectives are. Like, do you think our government should be trying to ease cost of living in smart ways, or do you think they should let people feel the pain while we're still in a relatively stable environment, because that's the only way we're going to get through it? That's not trying to color the conversation, but I'll throw it to Brad first. You tell me what you think, and then we'll see what Jolie says.
Yeah, I think they should look at the cost of living pressures for those that are in specific circumstances. So I think for those over the age of 55, 60, maybe on the pension and the rest of it, and are seeing kind of the pension not staying in tune with inflation at the moment, and are looking at risk of, so I mean, I think our last kind of pension date was 1979. I think July 1st. Anytime after that, you're not getting the pension, you got to sort yourself out. Anytime below before that, so pensioners today, they're going to end up falling on the government some way or another in the future if they chew up all their money or the pension doesn't kind of cover their costs and the rest of it. They're not going to let them go homeless. And so there's got to be something in there for those that are impacted, certain demographics, I would say. And that's a hard bit in Australia. Where's that line, right? And do you cover New Start allowance? Do you cover students with rent assistance? My thing is no. Unless they are regional students coming into the city for educational purposes, there may be something there. But maybe it's hard. But there's also home, and these kind of sometimes these hard kind of you have to wear it and it's going to hurt a bit. That in those cases, I think you should be hurting a bit. Then there's those cases where these finite money, you're over the age, you're on the pension, and you can't pay for your rent. The government's got to step in some of those circumstances. So I think Australia should be looked at as Australia as well. I think the US is a completely different kettle of fish, and we will talk about that after this question around what's going on there with First Republic and community banks and the rest of it. But Australia's Australia. We should look at our economy. We should look at those in need that can't afford to, they can't just wear the pain, i.e. they'll end up on the streets. Need to help them. Those that just need to wear some pain need to wear some pain. Jolly.
And Arnie, the question was around government intervention in terms of helping.
Yeah,
just
so I was
for me.
hypothesizing that in the coming budget, the government is going to include some kind of cost of living relief. I'll come.
They've said they are. Sorry, they are going to.
Yeah,
they've already come out.
But we don't know what form it will take. So I was trying to draw a comparison between America undoing all of their good work with quantitative tightening. In the short term, in long term they might be fine. And I'm wondering if our government will essentially counteract the rate rises by injecting money into the system, which is this, catch-22. People get money, they spend it, inflation goes hot again. So I'm wondering.
We saw that. It's a good question, Arns. Yeah, we saw that in the UK last year, didn't we, with the Prime Minister that had the shortest stint in record history and trying to bring all these tax cuts and incentives and essentially stimulate the economy that didn't need a stimulating, because, government's role is to serve its citizens, and, they want to be appealing to the bulk of people and seeing to be looking good and looking the part. And I guess that's where you spoke about the Greens before, and they've always done it. Leading up to an election as well. Budget might be a little bit different, but leading up to an election, they don't like rate rises when the RBA rate, because people, the general punter, thinks that the RBA and the government's the same thing. It's not. It's independent. It's separate. But they and the media, the government will play on that, and that's why the Greens have come out saying it should be a government decision, and it just shouldn't be. And there's so many different factors that come in, like you spoke, Brad, about copying the US and even in Australia, like copying the UK with some of the stuff they've done around housing and disincentivizing investment. That happened in the UK ages ago, and investors have started getting out, and now they're huge short supply of housing and accommodation for people. So, I think the governments will always have a part to play in making sure that bottom line of person that is protected, and that that poverty line's at a highest level that we can. In Australia, we're pretty good at that. I think our homelessness is quite good, although it's probably gotten worse recently with the lack of supply of housing. And there's cost of living pressures. I think it's at the moment it's a bit of an aberration, because we've cost of living pressures with inflation, and people are feeling the pinch, which it needs to happen. I think people need lessons of higher interest rates to realize they have to tighten their belts a little bit too. But I think medium to longer term, governments, like, without getting on a huge rant, government just have a place to play in terms of fundamentally setting things up so that people have the best chance to do well and succeed in life on their own 2 feet, whether it's supplying employment opportunities, making sure renewable energy is in the right spot, infrastructure is on the right track, and superannuation changes. That's another thing that's sort of in our industry. We see it all the time with fiddling with super. People are trying to plan for their future to, put some money aside for their own nest egg in retirement and not be a burden on taxpayers as age pensioners. Yet they sort of change the goalposts so that all the time, because it becomes a political pawn that they can play with for budgets. So really, like, there's so many different things that come into play. Yes, I feel like there's a bottom level that we need to protect and make sure that they're looked after and the vulnerable. But then, yeah, I think the government has a role to play, more of a medium term, longer term play, to say, let's just set things up so that we're not wasting money on things that, one party agrees on, one doesn't, and then we deliberate and then we get nowhere, and then, it gets cancelled or this gets done. And I just find that sort of stuff does my head in, because we want to sort of be pressing forward and have less wastage. So anyway, that's my 2 cents.
Good one, boys. Well, let's
Good.
move on. Nice segue into the FRC and the banking stuff, because, yeah, as I said, I drew the comparison. Brad, are you going to lead us off on the banking stuff?
Yeah, why not? So First Republic Bank gone. Another one. Just second biggest
Gone.
second biggest bank in America's history to disappear. My bank, unfortunately. But I'm sure I don't even know. I can still log in, so that's always a good thing. I have a mate who started up a VC fund at the end of last year, and their money was sitting in First Republic. I was like, surely you diversified, and I haven't actually heard back from him. So I'm hoping, not gonna name names, but out of there, anything but $250,000 like we did at Hammertech. But I think we've got big that stepped in. One of the big banks that stepped in and tried to prop up First Republic was JP Morgan. I think we touched on that about 3-4 weeks ago. Well, they came in with about $30 billion worth of deposit to kind of shore up everything and try and, I guess, stop what's just happened. But for those that haven't kind of listened to a previous pod, First Republic Bank is one of those community regional banks, non kind of FDIC insured outside of the kind of 250,000 bank deposits. It had a very, very similar makeup to SVB or Silicon Valley Bank in terms of high net worth depositors. So kind of, more aimed, 80-90% of their depositors had over $250,000 in their accounts. So high net worth and used by startups largely and venture funds, and had the same kind of bond issue in terms of kind of the amount of bonds that they purchased, and then the impact of the Fed rate rises, the quick rate rises had on the bond values. And those bonds were looked at as, depending on how you held them in the short term or for long term. If you held them on your balance sheet for the long term, they were seen as kind of cash equivalents. And we kind of saw that kind of unwind. Silicon Valley Bank and a few others. Now we see that it's unwound First Republic Bank. And so some quick details before just kind of throw over the boys for thoughts on this one. We've got the US rate rise tonight, so tomorrow US time. JP Morgan, so the First Republic bank was taken over by the FDIC kind of conglomerate, and looked for offers, and JP Morgan Chase came in and paid. Jamie Dimon came in and swooped on it, $10 billion for First Republic. And that includes $92 billion worth of deposits. That includes $173 billion worth of loans and $30 billion worth of securities, i.e. bonds. It's estimated that they're going to be making about $500 million on the lower end and $1 billion on the upper end profit off these assets moving forward. Not bad, swooping in for the $10 billion. And I believe the total now deposits at JP Morgan Chase has blown past the 10% of all US deposits. And that's actually legislation that no banks are supposed to be allowed to have, for risk purposes, over 10% of the US deposits. But due to this being kind of one of those times where they needed a bank to come in, Jamie Dimon's kind of swooped in and got that. So the next day of trading, being Tuesday in America, saw the markets respond to, I guess, what happened. And you had At one stage during the day, the index of regional banks was down 8.1%. That is the index, not just one bank, the index of all American regional and community banks. And these regional community banks do put up the majority of the money for, the small businesses, which employ 47% of kind of all Americans. They put up the commercial loans for the commercial property within generally those vicinities. And so, they play a much bigger role than in Australia. Very rarely will we have a First Republic Bank being kind of a regional bank with 200 billion, 300 billion worth of assets. And so, just interested in people's, both Joel and Arnie's, your thoughts on the US rate rise tonight. Will they go ahead? And everyone's going to say yes, but what are your thoughts on that? What are your thoughts around First Republic and the other commercial banks? And then we'll have a quick chat after that just about some of the latest concerns brought up by Charlie Munger around commercial property possibly being the next kind of GFC causing bigger than GFC because 1.5 trillion. But we'll throw over to you first of all around kind of your thoughts on the rate and on latest First Republic. I'll go to Jolie.
Yeah, I think just broadly, the government, the American government, and then the banking sector over there, they want to shore up security of the general public, and I feel like that's sort of where this lies now. I think they've learned a bit from the GFC. They are where things, it was a different time, but things ran its course, and it just caused so much turmoil. They're now trying to get in really quickly and have your JP Morgan Chase come in and shore up security and comfortability in the banking sector. Whether it's there or not, it's more of a perception thing, so they can avoid issues with bank runs and all those bits and bobs. So that's sort of probably the main thing that I'd add to that. I think you did a good rundown there, Brad. I guess the latest in terms of the current sell-off. So the regional banking ETF overnight dropped about 6%. So traders just question the stability of some of the smaller regional financial institutions after the recent crisis that we've had back in March. So that's probably, that's where I'd sort of say that lands at the moment. The other dot point I've got here is JP Morgan shares have given back a little bit of the gains had from the previous session after they took over First Republic, where they had a bit of a kick up, and other banks obviously sold off as well as part of that. So they're probably the main things. There'll be more to come, but I think they're acting pretty quickly, and some of those big hitters are starting to come into play now. Whether that 10% thing changes, Brad, I'll be interested to see whether they revise that and say maybe there's something to learn from other countries with bigger instos to say maybe there's more security around that. Time will tell whether they change that.
My thoughts on the matter are like the initial thing that springs to mind is that if you have been doing the work, you could be looking at some of those regional banks that are very well placed to ride this out and be buying them at a discount. I'm sure a lot of them are undervalued, and I'm sure a lot of them are on very sound financial footing. But there's so many. I think maybe you, Brad, or someone told me that there's something like 5,000. There's like something like 5,000 plus regional banks in America, which blows my mind. I know they've got a large population, but that's a lot of banks. So it would be hard to sort of filter through those and find the gems, but I'm sure there are some. JP Morgan, 2.4 trillion in deposits. That is an unbelievable amount. My general thoughts on the matter are, I do think a response was warranted to save the banking sector when the Silicon Valley Bank thing occurred. I think they may have overdone it by reversing the quantitative tightening and going sort of back to like something like QE. Like, even though the government in America came out and said that this cost will not be borne by American taxpayers, it will be a levy on the banks in future for these support services like the facility where they could change over their bonds and the discount window. I forget exactly what was occurring. I think they overshot that, and I think they should, in some way, shape, or form, like protected depositors, but let banks fail, because you've probably heard other pundits say that we're in like an everything bubble, and bubbles are bubbles popping are part of an economic cycle. So to Jolie's point, like I don't disagree that they're trying to get in early and sort of forestall the worst of it, because no one wants to see a catastrophe where everyone's hurting and in a lot of pain and could have significant contagion and knock-on effects. But at the same time, you can't just keep propping it up forever, because then you just keep inflating the bubble. And that's what we've seen. Like, should asset prices be where they are today in America? Maybe not. Like maybe we should be going into a bear market, but it's a weird like cyclical bull within a bear. I don't know. I feel conflicted about it. I don't know what the right answer is here, but that's where my head goes.
I think it's so complicated, right?
Yeah, it
I
is.
think that's why it's so hard to kind of go, where should it be? Because it's not exactly playing on your standard kind of economic models and what the majority of the world. America is an out because of the reserve currency. It is an outlier because they have the ability to do things that other people can't do. I do feel like they've pushed that complication so far from probably the GFC 2008, and they've kept kind of feeding off it. I think they've complicated themselves so much they don't even know where they probably should be or where the right amount is, and that's a hard bit, right? They're trying to steer the ship, but not really know, because this is all new ground. It's the first time they've ever had this much kind of balance sheet on the Fed, etc. Quantitative tightening during high inflation, during low unemployment, during it's still a pretty wacky upside down area. But I guess going back to Joel, I think they have learned a lot out of the GFC on bank failures, and knowing that letting banks go totally fail is kind of not good for capital markets, and confidence kind of comes into that machine of capital sharing. And last but not least, before I throw back to you, Arnie, because I know your hand up, a couple of things really quickly. 4,844 commercial banks that are currently under the FDIC. So kind of there is a lot of banks in America. And quickly, the futures market implies a 19% chance the central bank will keep rates the same, and 81% chance that it will go up by 25 basis points. Arnie, quickly, before we wrap up on the commercial and move on to 50-50.
Yeah, final points. Impossible for them to insure all of the deposits. You and I have spoken about it, and I think it's like 17 trillion, and that's a ridiculous amount given their current state. Charlie Munger, I haven't read that about the commercial real estate, but I think that makes logical sense. Like if you think about the pandemic effects and working from home and all the office space that isn't currently being used, and there's going to be that I could see, significant risk there. Again, my mind turns to REITs in America and just seeing what the underlying investments are, because if that sector takes a hit, you might pick up some good bargains in ones that aren't exposed to a lot of commercial real estate but are exposed to other types of property. And on that last point there, which I forget what you said, Brad, but you made a point just then which I was going to mention anyway. We'll move on, but it's an interesting
interest rates.
Oh, interest rates rising. Yeah, I do. I absolutely think that the US Fed will raise, and I think it's appropriate. As long as they don't have to keep injecting money in, and they can hold rates high enough and let money drain out of the system, they're going to get their achieved outcome. But yeah, it's just a matter of threading the needle and what happens. Does something break before that happens? And if it does break, should they let it break? Anyway.
Jolie, any other thoughts before we move on to the commercial stuff?
Yeah, no, I think in a segue jumping into the commercial stuff now, it's like when you talk about commercial, you've got so many different areas of property. You've got commercial, residential property, office property, you've got shopping centers, and then you can also push into like private equity area, like your airports, your infrastructure tollways. So there's many different varieties when it comes to those big spaces and big areas. So it's not all treated equally. It can be all different. Like infrastructure, for example, I think it was Transurban I was reading about the other day. Their tollways, they've got them inflation linked, and they've pegged themselves to a fixed rated interest rate. So they're increasing their fees with inflation, but they're also not paying as much because they've fixed their rates. Private airports are also different as well. They've been, there's private airports that have been taken over by different super funds and whatnot. So there's definitely areas in there and pockets in there. But I think as an overview, yes, office spaces would be if you think about pre-pandemic, the demand for office space, and now we've got this completely different world, that demand naturally will have decreased, and there's still the same supply out there. So yeah, I think it's a changing landscape. So it'll be interesting to hear your boys' views, and Brad, I think you've got some things to dot point off for the listeners before we move into 50-50 territory.
Yep. So when I'm talking about commercial, like the concerns around commercial property, I am talking about the categories of shopping centres and office buildings. Largely, they do touch on data centres, but for a different reason, and that's more from a logistical supply issue at the moment. So let's put them over there, and let's just focus on shopping centres. And largely, the data I'm talking about here is in the US. There is a bit of information that the AFR has come out with about 2 weeks ago on their thoughts around commercial property here in Australia, because again, different markets, different stuff, right? For instance, in the US, the majority of property that is domestic, like houses, is at fixed rates. All commercial property, largely in shopping centres and office building, is on variable rates, which was something that interesting that I kind of found out. I didn't realise the commercial loans in America are different to kind of your everyday property loans. I thought they would be fixed as well. But so I guess the thing that's kicked off some of the thoughts around commercial, because this has been hanging around since 2020, COVID, right? So once COVID took out the majority of office workers and they went back to working remotely. So some quick stats during COVID, not in Melbourne, because I'm sure it'll be a lot higher than this, but in America, during 2020, we had 41.7% of all Americans working remotely. That dropped down to 26.7% in 2021 and is sticking at 26% in 2022. New York current official data around office vacancies is 16%, where they're estimating it's probably more like 25 to 30% in real terms. The reason why there's a bit of concern at the moment around, I guess, commercial office buildings is one, obviously the trending in remote work and the highest vacancy rates, I think they said ever in New York since the 1930s. So we're talking about in the last 90 years up until 1939. And there is 1.5 trillion wall of debt looming for US commercial properties in the next 20 months. And that goes up to another 550 billion per year added to that by 2027. And they're saying that investment bank estimates office and retail property valuations could fall as much as 40% from peak to trough, increasing the risk of defaults. Because in America, and I'm sure, probably makes sense worldwide, if an office building valuation goes down by 40%, then your kind of LVR on that, the banks actually call in and say, cool, your property, your $400 million building on 5th Street is now worth 250. Your loan's for 350. We need 130 to keep this up, otherwise we're taking over your property. And so there's a wall, similar to kind of a wall of variable to fixed loans coming off in Australia for domestic housing. There's a wall of debt that's coming up on for expiry, and it won't be able to roll over if these valuations drop. And so a lot is held by the community banks as well, and so that's why there's even more, I guess, focus on this at the moment, is that because the community banks already kind of suffering from bonds like FVB and First Republic, etc. They're not exactly, it's not thought that they're in the healthiest of positions to be able to kind of wear some of the delinquencies around these huge costs, commercial buildings around residential and the rest of it. They don't believe that there's really going to be any return, like forecasts aren't looking at any returns over the next kind of 5 years of office workers to bring back the demand to increase, reduce the vacancy rate down, so you can actually start continue charging what they're charging today. So outlook for commercial property.
really
Yep, sorry.
quickly on the utilization of space as well. I think you talk about the vacancy rates, but then if you talk
Yes,
about
sorry, yeah.
the rates of people in office buildings, but they're only in there 2 days a week.
66, so 66% of US office workers are working at least 2 days away from the office, so hybrid working, right? And interesting you say that, Jolly. Hammertech, we just took over a new floor in the CBD in Melbourne for the first time. And I was in there, worked in there and had a look at the new office. Nice, right near Supernormal, so it's good local to now have. But I kind of said, is this big enough kind of for everybody? And it's a whole floor. There's a lot of kind of community space and meeting rooms and stuff like that. And they're like, yeah, I mean, look, there's only ever 1 day a week, maybe, that we get 70-80% of people in. Everyone's just doing three days. And so where we would have had to hire, lease out 2 floors, Joel, back in let's just say 2019, 1 floor is now easily enough for us. So I'm guessing that's the point that you're going towards, which is not just the vacancy rate, but then the amount of people or companies that now, like Hammertech, instead of 2 floors, are taking out 1. Sorry, Arnie, before you, Joel, is that what you're...
Yeah, that's what I was alluding to, is that space utilization. It's just a different, I think it's a different model now. And the vacancy rates is one thing, and then it's those the amount of space that you're using and how often you're using it. And that's where you see these companies now at your local shopping centers. I forget what they're called, Watermans. They're opening up these office buildings where people can just go in and go out and use it as a membership option, because there's so much flexibility that people want to have, and they can take permanents, they can pay for days, they can pay for hours, they can take meeting rooms. Is it a new era where we're moving into in the commercial space, and I think possibly some adaptation around that. Arnie?
That's an interesting thought, mate, like a communal working space, and you can sort of just, go in there. On that point, it's got knock-on contagion effects to all the businesses in those areas around
100%.
the commercial real estate. And what I think it might lead to is, again, pain. But you're going to have, like, if it plays out the way it should and there's no government intervention propping it up or subsidizing it, you should see a transfer of wealth. People who can't afford to maintain those loans or refinance, like you suggested, Brad, those properties will change hands, and someone might get it in a fire sale. And like, will the rich get richer? Potentially. But then around those businesses where you've got the service businesses, the coffee shops, the lunch places and whatnot, they're going to have to renegotiate their rents to say, we were previously getting X amount, 100% of our dollars were coming in. And now with this hybrid working, like you were suggesting, there's lower rates of foot traffic and people coming through, and we're getting this much. For us to survive, we can only afford to pay this amount of rent. So those valuations coming down will be justified by, I guess, the velocity of money in that local small economy. Ultimately, like, to not be a doom and gloom, you could view that as a positive thing. It's going to have opportunities for people to come in and try new businesses, business turnover, where previously there was a high barrier to entry because of the costs in those spaces. Now it might be lowered, and people might be able to try something new, like what Jolly was mentioning, this subscription-based office working model. Anyway, it's interesting and not all doom and gloom.
I think interesting points all around. I think there's a stack of bars and restaurants going bankrupt at the moment because they're still paying the kind of rental prices. One around the corner from me, I love it, Crux Cafe, and they're just big sign up saying vendors taking back over because they haven't paid back all their rent during COVID. When you're in lockdown and couldn't pay rent, and then they're still charging the same amount of rent, even though there's less foot traffic, no office workers. And so, that's all got to play out. And in any kind of really big kind of recession or hurtful, thing, there's always the green shoots, right? It's like a fire comes through and then, stuff gets to grow back. But I think we jump over the 50-50 because I think we've smashed out the time here today.
All right, boys, I got a good 50-50 for you. And it's off the back of Kate, my wife, making probably the most delicious tomato soup I've ever tasted. Ooh. She used the most fresh ingredients, and it was fantastic. So it made me think, what's my favorite soup?
Shout out to Kate.
Yeah, shout out to Kate. And my favorite,
I would have said soup on her birthday to Johnny.
No, it wasn't on her birthday, mate. Birthday weekend, though, she made it. But and you know what? This soup was so delicious that I didn't believe that my kids would eat it, but they ate it up. Charlie had 2 bowls. So, that's how good this soup was. Normally, they're a bit fussy with stuff like that. Anyway, so it made me think what my favorite soup is, boys. So I'm going to give you a bit of a third today, and maybe you just choose one, but then you can say what your favorite soup is if it's not one of those three. So pumpkin soup, carrot soup, tomato soup. What are you choosing?
My actual favorite soup is one that shout out to Ez. Actually, she makes this one. It's a ham hock, pea and ham soup with ham hock. That's sensational. If I was to choose out of the three, Arnie, you said pumpkin, tomato, and
carrot.
I don't know if I've ever had a carrot soup before, but I do love a good pumpkin soup. Even though I don't like pumpkin the vegetable that much, I don't mind pumpkin. I didn't like it growing up. I don't mind it now, but I like a good creamy pumpkin soup. So I'll be going with creamy pumpkin for me, Arnie. Creamy being the key word. Needs to have that little bit of dollop of cream in the middle of it.
Yeah, you could add a little bit. Battles, what about you?
Can I have bread on the side too?
You need bread on the side. Butter.
Kate served it with garlic bread, so let's say they all include garlic bread.
Done. Again, like in wedding soup or a minestrone or a nice cauliflower soup, they're my favorites. But if out of your three, tomato soup with some hot bread and some nice fresh butter on top.
See,
go wrong.
I would have said previously that pumpkin was my favorite soup, but having tasted this soup, I'm a convert. Kate's tomato soup is now my favorite soup in the world. And with the special, the nice fresh bread and making the garlic bread, it was just fantastic. So yeah, I'm going with that one, boys.
Kate is making a man happy through the stomach. Everybody,
we're going to start a new CBD business with some cheap commercial real estate. Kate's tomato soup,
soup Nazi tankers,
Love it. All right, boys.
Well, thanks again for listening in, Tankers. It's always a pleasure to have you here and joining us and covering all things financial and helping you guys get an overview of what's going on in the latest markets. Episode 63. Arnie, where can the Tankers get us at, and where can they get us with any Q&As they might have or topics they wish to discuss?
Yeah, get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And please leave a like, comment, subscribe, and click the little bell. And we're open to your 50-50s and your Q&A. We love it. So cheers, Tankers.
Keep them coming in, and next week we'll look to tackle the latest in the property market and what's been going on there, as well as maybe a bit of a crypto update as well from Brad. We do have some guest speakers lined up, so bear with us. We're just going to organise dates for those ones, but we've got some good subject matter experts coming up. So stay tuned, Tankers. Tune in next week. We always appreciate you coming along and get those questions in as well. Thanks very much, and enjoy your week. Cheers, guys.
See you guys.
See ya.